I'm joined now by Gavin Stacey, who's Chief Fixed Income Strategist for Australia at Barclays Capital in Sydney. Well, let's get that question out of the way straight away then, Gavin. What do you think the RBA's next move is going to be?
Certainly the next move by the RBA is to the high side, and we think it's probably sooner rather than later, despite market pricing. And it largely comes down to the fact that when it comes to RBA decisions, really you look at their own forecast. The RBA is forecasting above trend growth by the end of this year, and it's expecting underlying inflation at the top of its 2 to 3% band. So that normally signals that they're going to act, and act soon. You
think they're going to do it in June?
Yeah, I think it's a good chance. It's certainly a bigger probability than the market gives it. The market's thinking maybe 5–10% chance. It's got to be a lot greater than that, given that the RBA effectively has told us in the Statement of Monetary Policy, which came out a couple of weeks ago, that they're actually thinking of doing 2 rate hikes this year. If that's the case, they better get going.
Right. Now, the Australian dollar, it is up some 29% in the past year. That's got to be weighing on the minds of the RBA because, of course, the Australian dollar being high is great if you're exporting resources, but not if you're in some other sectors of the economy.
Oh, you're absolutely right. I think when you look at certain parts of the economy, tourism, manufacturing, education, those parts of the economy are certainly suffering under the weight of the strong Australian dollar. However, when you're at the RBA, you're looking at the average of the economy. Some parts of the economy are doing well, the miners, and other parts of the economy are not doing well. So poor old RBA has to target the midpoint with an eye to keeping underlying inflation in that 2 to 3% band. So unfortunately for the RBA, there's going to be winners and losers. However, when it comes to the A dollar, we basically think it's overvalued at the moment, and while that would normally be a problem for a central banker, in the RBA's case, given they believe they are still fighting inflation, the A dollar is actually a friend rather than a foe.
Because of the cheaper imports that they get, correct?
Absolutely, yeah, that's right. It works 2 ways. Right. Obviously, lower import prices keeps the CPI under control, but also, they are trying to cool down certain parts of the economy. The miners, they can't control because they don't care about interest rates. They fund their investment via internal funds. Unfortunately, the RBA is trying to cool down those non-mining parts, and the A dollar is sort of part of the mechanism.
So, Gavin, from the outside looking in, it looks like Australia really depends a lot on this resource industry. Is it a one-trick pony, or is there more to it when it comes to the Australian economy?
Of course, we'd like to think the Australian economy is this diversified modern economy, but unfortunately, all roads lead to the mine when it comes to Australia. The terms of trade, commodity prices, drives nominal GDP growth, it drives immigration, it drives house prices, it drives wages. It really is a one-trick pony. So, thankfully, that one-trick pony is running strongly at the moment. Unfortunately, when it turns, whenever that may be, and we don't expect it to turn downwards anytime soon, then I think the Australian economy is in for a bit of a tough patch. But thankfully, global central banks are not really stamping on the brakes. They're just sort of tapping away at the brake, and therefore the commodity price story is probably going to continue to drift higher, and that in turn keeps the Australian economy on a sort of positive growth front.
Keeps the pony going. Gavin Stacey, thanks very much.
Yes, that's it. Thank you.